From the dawn of civilization, one metal has captivated humanity like no other. It doesn't rust, it doesn't tarnish. Its brilliant luster has been a symbol of power, divinity, and eternity. This is the story of gold, the silent force that has shaped the destiny of empires. For thousands of years, this precious element has been more than just a currency. It has been the lifeblood of nations, the fuel for conquest, and the bedrock of global economies. From the pharaohs of ancient Egypt, who believed it was the skin of the gods, to the Roman emperors who paid their legions with golden aurei, control over gold meant control over the world. The quest for gold drove Columbus across the Atlantic, igniting an age of exploration and conquest. The immense riches plundered from the Americas flooded into Spain, funding its golden century. Yet, this sudden influx of wealth, without a corresponding growth in production, led to rampant inflation and ultimately contributed to the empire's decline. It was a lesson learned the hard way. Gold can build an empire, but it can also hollow it out from within. Think of the California gold rush in the 19th century. It didn't just create fortunes for a lucky few. It accelerated the westward expansion of the United States, transformed its economy, and cemented its status as a rising global power. The promise of gold redrew maps and built nations. In the 20th century, the world attempted to tame gold's power through the gold standard, linking the value of currencies directly to reserves of the metal. This system promised stability, but it also proved rigid and unforgiving. The Great Depression exposed its weaknesses, forcing nations to abandon it in order to regain control over their own economic destinies. The direct link was severed, but gold's influence never truly vanished. Even today, in our digital age of cryptocurrencies and complex financial instruments, gold remains the ultimate safe haven. Central banks around the world hold vast reserves, a silent testament to its enduring power. When markets tremble and uncertainty looms, investors flock to gold, just as our ancestors did. It is a timeless anchor in a volatile world. The story of gold is a mirror reflecting our own history. It reveals our greatest ambitions and our most devastating follies. It's a tale of obsession, of power, of creation, and of destruction. Empires rise, they flourish, and they fall. But through it all, gold endures, a silent, gleaming witness to the endless cycles of human history. Thank you for joining us on this journey. If you found this story fascinating, please like this video and subscribe to our channel for more deep dives into the forces that shape our world. See you next time. Have you ever wondered why we're so obsessed with gold? For thousands of years, this shiny metal wasn't just for jewelry. It was the bedrock of entire economies. But how did a simple element become the ultimate symbol of wealth and trust? And what can its story teach us about the money we use today? Let's dive into the fascinating history of the gold standard. Our story begins in the ancient world, long before paper money. Imagine you're a merchant in the Roman Empire. You need a way to trade that's reliable. You can't exactly carry a herd of cattle into a shop. This is where coins came in. Early empires like Rome and Persia started minting coins from precious metals, primarily gold and silver. Why gold? Because it's rare, it doesn't rust or tarnish, and it's easily divisible into smaller units. A gold coin had intrinsic value. Its worth wasn't just a promise, it was physically in your hand. This created a universal language of commerce. A Roman aureus was valuable in Rome, in Egypt, and even on the fringes of the empire, because it was made of pure gold. This system built an incredible level of trust. You didn't need to trust the emperor's word. You just needed to trust the weight and purity of the gold coin. This concept of money being backed by a physical commodity is the core idea of the gold standard. As economies grew more complex, carrying around sacks of gold became impractical and dangerous. This is where the first bankers entered the scene. Think of them as glorified safekeepers. You could deposit your gold with a goldsmith or an early banker, and in return, they would give you a paper receipt, a banknote. This piece of paper was a a claim check that said you could redeem it for a specific amount of gold anytime you wanted. Suddenly, commerce became much easier. Instead of trading heavy coins, people started trading these paper receipts. This was a massive innovation. As long as everyone trusted that the bank had the gold to back up its paper, the system worked beautifully. This trust was everything. If even a rumor spread that a bank couldn't honor its receipts, you'd have a bank run, with everyone rushing to get their gold back at once, often causing the bank to collapse. So, for this early version of the gold standard to work, banks had to be disciplined. They couldn't just print endless receipts. The amount of paper money in circulation was strictly limited by the amount of gold they held in their vaults. This brings us to one of the biggest advantages of the gold standard: discipline. When a country officially adopts a gold standard, it means its government promises to convert its currency into a fixed amount of gold on demand. This puts a natural limit on how much money the government can create. It can't just fire up the printing presses to pay for wars or fund lavish projects. If it wants to print more money, it first needs to acquire more gold. This imposed a strict fiscal discipline that helped keep inflation in check. For centuries, the prices of goods and services remained remarkably stable in countries on the gold standard. Your savings were safe because the value of your money was anchored to something real and finite. The classical gold standard era. From around the 1870s to the start of World War I in 1914, is often seen as its golden age. Major economies like Britain, Germany, and the United States were all on it. International trade flourished because currencies were all pegged to gold at fixed rates. Exchange rates between countries were stable. A British pound was worth a certain amount of gold. A US dollar was worth a certain amount of gold, which made it simple to calculate how many dollars a pound was worth. This predictability reduced the risk for businesses trading across borders, leading to an unprecedented period of globalization and economic growth. It was a finely tuned global machine, all lubricated by the universal trust in gold. But this rigid system also had a dark side. Its greatest strength, its discipline, was also its greatest weakness. What happens when a country faces a major crisis, like a war or a severe economic depression? Under a strict gold standard, the government's hands are tied. It can't increase the money supply to stimulate the economy or fund a war effort. This inflexibility became painfully clear during World War I. Countries needed massive amounts of cash to pay for soldiers and weapons. The only way to do that was to abandon the gold standard, temporarily at first, and print the money they needed. They suspended the promise to convert their currency to gold. After the war, there was an attempt to rebuild the gold standard, but the world had changed. The economic devastation, the massive war debts, and the shifting balance of global power made it impossible to return to the old system. The Great Depression was the final nail in the coffin. As the economic crisis deepened in the 1930s, countries were desperate for ways to fight unemployment and deflation. The gold standard forced them to keep interest rates high to protect their gold reserves, which only made the depression worse. One by one, nations abandoned the gold standard to regain control over their monetary policy. They devalued their currencies and started printing money to try and jumpstart their broken economies. The United States held on the longest. For a while, under the Bretton Woods system established after World War II, the US dollar was pegged to gold, and other world currencies were pegged to the dollar. The US held the majority of the world's gold reserves and effectively anchored the global financial system. But by the 1960s, the costs of the Vietnam War and growing social spending put immense pressure on the US dollar. Other countries began to doubt if the US actually had enough gold to back all the dollars floating around the world. They started redeeming their dollars for gold, draining US reserves. The breaking point came in 1971, in a move that shocked the world. President Richard Nixon announced that the United States would no longer convert US dollars to gold at a fixed rate. This act, known as the Nixon Shock, officially severed the last link between the world's major currencies and gold. The era of the gold standard was over. we entered the world we live in today, the world of fiat currency. So what does fiat mean? It's Latin for "let it be done." Fiat money, like the dollar, euro, or yen you use every day, has value simply because the government declares that it does. It's not backed by a physical commodity like gold. It's backed only by trust in the government and the stability of the economy. This gives central banks incredible flexibility. They can increase or decrease the money supply to manage inflation, fight recessions, and stabilize the economy. But it also comes with a risk. Without the anchor of gold, there's a constant temptation for governments to print too much money, leading to inflation and devaluing the savings of its citizens. The story of the gold standard is a powerful lesson in the nature of money. It shows us the deep human need for trust and stability in our financial systems. It highlights the eternal tug-of-war between discipline and flexibility. While we no longer use gold as money, its shadow looms large. The debates about cryptocurrency, central bank policies, and the future of money are all echoes of the questions that the gold standard forced us to confront. It reminds us that money, whether it's a shiny coin or a digital code, is ultimately a social construct built on a foundation of collective belief. What do you think? Could a return to some form of a gold standard solve our modern economic problems? Or is it an outdated relic of a bygone era? Let me know your thoughts in the comments below. Thanks for watching, and if you enjoyed this journey through monetary history, don't forget to like and subscribe for more. See you next time. The moment an empire begins to strain its monetary foundations, the symptoms appear long before collapse becomes visible. For Britain, those signals emerged not in politics, but in finance. The gold-based system that had once amplified imperial strength began to expose its limits, revealing a tension that no amount of naval power could resolve. Empire was expensive. Maintaining overseas territories, policing trade routes, and projecting authority across continents demanded constant expenditure. Wars accelerated this burden dramatically. Each conflict required borrowing on a scale that peacetime revenues could not support. As debts accumulated, the promise embedded in the pound sterling grew heavier. Every note, every obligation remained a claim on finite gold reserves. At first, confidence endured. Britain's reputation for honoring its commitments sustained global trust. London remained the world's financial center, and sterling continued to function as a reserve currency for international trade. But credibility is not static. It is consumed gradually, often invisibly, as pressures compound. Gold began to flow outward. Trade imbalances widened as industrial competition intensified and imperial costs rose. Maintaining convertibility required deflationary adjustments at home. Prices and wages were forced downward to protect gold reserves, shifting the burden of imperial finance onto domestic society. Economic pain became a political cost. This was the hidden price of monetary discipline. Gold did not distinguish between strategic necessity and fiscal excess. It treated war spending and welfare spending alike. When governments attempted to prioritize imperial ambition over domestic stability, the system responded mechanically, not sympathetically. The turning point came when maintaining the appearance of strength conflicted with economic reality. Clinging to gold convertibility demanded sacrifices that increasingly undermined growth and social cohesion. Suspending it, however, threatened the very credibility upon which Britain's financial dominance rested. Either path carried risk. When convertibility was weakened or abandoned, even temporarily, the signal was unmistakable. Markets understood what politics could not disguise. The empire's financial structure was under strain. Sterling's authority no longer rested solely on gold, but on confidence in future management. That shift marked a profound change. Power moved from metal to institutions, from automatic discipline to discretionary control. Banking power, once anchored firmly in gold reserves, began to depend more heavily on policy decisions and international coordination. Britain's role as the center of global finance did not vanish overnight, but its foundation altered. The system became more flexible, but also more fragile, and the consequences extended beyond economics. Monetary constraint reshaped imperial strategy. Commitments were reconsidered. Influence receded where costs outweighed returns. Financial reality dictated geopolitical retreat long before formal decolonization began. Empires rarely fall through conquest alone. They contract through balance sheets. Perhaps most revealing was a psychological shift. Gold had provided an external standard, an objective limit that restrained ambition. Without it, discipline relied on judgment, credibility, and trust in institutions. That trust proved harder to maintain than metal reserves ever had been. Britain's experience was not unique. It followed a pattern visible across history. Monetary systems that empower expansion eventually confront the scale of that expansion. When promises multiply faster than the resources backing them, adjustment becomes inevitable. The form varies: deflation, devaluation, restructuring, but the logic does not. The gold system did not fail because it was flawed. It failed because empire demanded more than it could safely supply. The turning point was not a single decision or crisis, but the recognition that the monetary rules which built imperial power could no longer contain it. By the time the consequences became obvious, the structure of global finance had already shifted. Gold no longer ruled, unquestioned. Authority had moved, quietly but decisively, from metal to management. And with that shift, the age of the first monetary empires began its irreversible decline. When the gold-based world faded, it did not disappear because it was disproven. It vanished because the scale of modern power outgrew its limits. Yet the logic that governed those early monetary empires never left. It merely changed form. To understand gold's rise and decline is to recognize a recurring pattern in the relationship between money and authority. Every dominant system of power begins by anchoring trust. For centuries, gold performed that role with unmatched credibility. It constrained rulers, disciplined budgets, and rewarded restraint. Empires that aligned themselves with its rules gained stability and reach. But success bred expansion, and expansion demanded flexibility. Eventually, the anchor became a restraint. When Britain and other powers moved away from gold, they did not abandon discipline entirely. They replaced external constraint with institutional control. Central banks assumed the role once played by metal, managing currency value, credit conditions, and financial stability through policy rather than scarcity. This transition allowed governments to respond to crises, finance wars, and support economies in ways gold never could. But flexibility carries its own dangers. Without a fixed anchor, money becomes a reflection of trust in institutions rather than trust in substance. Debt expands more easily. Currency value depends on confidence in governance. The system becomes adaptive, but also more dependent on perception. This is the broader lesson of the first monetary empires. Power does not collapse when money changes form. It shifts. Authority migrates from what is tangible to what is believed, from metal to policy, from certainty to credibility. History shows that no monetary regime is permanent. Gold-constrained empire, fiat systems enable it. Both eventually encounter limits. Empires rise when their monetary system aligns with their scale and ambitions. They decline when that alignment breaks down. The pattern repeats, not because leaders forget history, but because power always seeks expansion, and money must accommodate it. Britain's experience offers a particularly clear example. Its financial dominance was not accidental, nor was its retreat sudden. It followed the predictable arc of a system that first enforced discipline, then required adaptation, and finally relinquished centrality as global structures evolved. The lesson is not nostalgia for gold, but awareness of constraint. Modern finance often treats money as a tool to be managed rather than a boundary to be respected. That belief has delivered remarkable growth, but it has also accumulated unprecedented debt. The absence of an external anchor means limits are discovered through crisis rather than design. Adjustment still comes, but it arrives later and with greater force. Gold once revealed excess early. Today, excess can persist longer, masked by policy and confidence. But confidence, like gold, is finite. It erodes quietly, then suddenly. The deeper pattern is this: monetary systems do not fail randomly. They fail when they are asked to support levels of power and obligation they were never designed to sustain. Empires are not undone by enemies alone, but by the financial structures that once enabled them. Understanding the first monetary empires is therefore not an exercise in history, but in foresight. It reminds us that money is never neutral. It shapes behavior, rewards certain choices, and punishes others. It defines what is possible long before politics makes it visible. When gold ruled the world, power was forced to confront its limits. In its absence, those limits still exist. They are simply harder to see. And history suggests that what is hardest to see is often what matters most.